Hello, everyone. As we're coming in, I want to thank you for attending. And I do need to do a bit of legal housekeeping before we start, but I wanted to say welcome. My name is Marche. I'm the webinar director here at Advice Chaser, and we're so excited to have you here today. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. And if you can move us to the next slide, I do have a couple of housekeeping items for our attendees. Oh, go to that one. Thank you very much. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the webinar presentation today as appropriate. We do have a question and answer period at the end of the presentation. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. And if we can't get to that question, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our guests today. Go ahead and move to the next slide there, Ed, so we can show your pictures, folks. Mark Seither is a partner and wealth manager with Kingsview Partners in Knoxville, Tennessee. He has a Bachelor of Arts in Economics from San Diego State University and began working as a financial advisor in La Jolla, California. Mark enjoyed finding innovative solutions to clients' complex problems, and his desire to work with the entrepreneurial minded helped him thrive as a financial advisor. As Mark honed his skills as an advisor and a planner, he looked for a platform that would better pair with his desire to work with clients needing advanced planning and specialized fixes. He found his spot back in Northern California in early 2017 when he joined Trust CFO and assisted in integrating complex tax and estate planning with wealth and investment management. Since then, he has collaborated with Josh Saunders to build Kingsview Partners. Together, they assist individuals on wealth management and tax strategies. Mark, why don't you go ahead and come off of mute and say hello to our guests, and then I'll introduce our presenter today.
Hey everyone, very excited for today's presentation. My business partner and I have known Ed for quite a while, and one of the things that we really appreciate about him is we've always stressed, taxes they're almost like wealth termites, right? If you're not paying attention, they can cause some real damage. So with the tax, complex tax advantaged vehicles, we just got to be careful. And Ed has been a great resource for, keeping the wealth termites away.
Well, I'd love to introduce Ed. Ed Cotney is the founder and principal at Olympus Tax, Business and Insurance Solutions, Inc., and the author of Tax Secrets Made Simple. He hails from Alabama and earned degrees in physiology and aviation management and served active duty in the U.S. Air Force for 20 years before retiring in 1998 in Northern California. Ed graduated from the prestigious professional mentoring program in Franklin, Indiana, where he became a family wealth counselor in 2000. Lauded for making the complex simple to understand, Ed is well known for providing continuing education classes to professional advisors, from basic to sophisticated estate planning techniques, business formations, mergers, private placement, research and development tax credits, domestic asset protection trusts, domestic international sales corporation, business succession planning, and multi-generational business planning. And Ed, we're so thrilled to have you here. And I'm going to turn the time over to you to present to our audience today.
Well, thank you, Marche, for that introduction. And Mark, thank you guys for hosting today. And without further ado, let's get into this so we can start getting smarter about taxes, IRAs, 401ks, and that type of thing. I'll begin this with, there's a lot of confusion at the IRS. In fact, we still don't have all the regs necessary that should be in place with all the changes that have happened over the last couple of years. But I do want to focus on a couple of things to help make certain that your IRAs and 401ks are properly used for the remainder of your life. And if you have IRAs and 401ks that transfer to your heirs, how to make certain they get the net best bang for the buck versus the IRS winning. So the most common mistakes that I see repeated over and over by both clients and their advisors: we miss out on annual tax planning opportunities. We don't take seriously estate tax planning because it's always a fluctuating, moving target. Some of us fail to take our RMDs when we're mandated by law, which, by the way, has changed over the last couple of years, and there's a proposal right now to change it again. There is a huge penalty when we don't take out our RMDs when we're supposed to. We don't plan for this death transfer. Sometimes we have children or grandchildren that are special needs that an IRA 401k could interrupt their access to certain types of government benefit programs. We also need to start taking into consideration the asset protection technicalities that we now have in place that virtually no one is talking about that became law in 2014. We're going to talk about that today and show you a couple of examples. And we're also going to talk about how people who, when they get elderly, they end up needing to have long-term care, maybe in-home care or moving to a care home, and they fail to claim the deductions on their tax returns. But more importantly, they fail to run the analysis of taking more than their RMDs from their qualified plans because they have the ability to get an offset in the tax issues. So we're going to hit several topics today, and luckily this is being recorded. You can watch it over and over. So we're not going to go very slow, but I'm not going to go so fast that's like, what did he say? But remember, this is a recording. You can go back to Marche and Mark and say, hey, I need to see that again. All right, COVID was here, economic turmoil, tax turmoil, lots of rule changes. So the Secure Act of 2020 did change some big rules, move the RMD from age 70.5 up to 72. It did preserve the qualified charitable distribution at 70.5. So people get these two ages confused because now they're not the same. We'll go through that one as well. And then, of course, the IRS made some major changes in respect to when we leave an IRA to the kids, what's the new rules? And then we're still trying to figure out Code Section 590-B. But here's the deal. Before COVID, before Secure Act, before the world went crazy, in 2019, the old rules were that when you die, your IRA and 401k can go to your children all at once. And if they're in a higher tax bracket, they just pay the taxes on it. And then they had two other ways to take out the money. There was this thing called the 5-year rule. And the theory being the kids could take the IRA distributed out over 5 years instead of all at once, thus distributing the wealth loss to taxation. Because remember, our kids, when they inherit these IRAs and 401ks, they're probably still working at their peak years of their income years. So they're probably already in a relatively high tax bracket. So clearly taking it all at once is just a hammer of a tax bill, particularly if you live in tax states like New York, New Jersey, and California that love to tax the daylights out of us. So we also had the old rule of the stretch option. The stretch option was this rule that the financial planning industry promoted to say, hey, mom and dad have died, you've inherited this IRA. If you take all this money out quickly or over 5 years, it's going to push you into a higher tax bracket. Why don't you elect the stretch option, take out an adjusted RMD for the rest of your life, but you still have the right to take out whatever you want, whenever you want. And it sounded good. It was a great pitch for everybody to go, okay, my kids will elect stretch option. Statistically, what we have learned is that over 95 to 98% of the kids don't do the stretch option. Mom and dad die, they inherit the estate, they spend some money. Oh, wow, there's that big IRA. Let's just go ahead and take a big chunk of that out. We typically find that most IRAs are fully depleted on inheritance within 2 to 3 years maximum. So the tax efficiency here to keep people in a lower tax bracket, it just didn't work. The new IRA distribution rules, well, we can still take it out all at once, but the big difference now is this 10-year rule. So if you die after January 2020, the rule is the parents have passed and the IRA goes to an inherited status. So it changes its status. It becomes an inherited IRA. So the nature and character of your IRA that you enjoy today literally changes from an apple to an orange. So we have a 10-year rule so that the kids can take out that money whenever they want to, but they have to take it all out within 10 years. And of course, there's still discussion going on about RMDs. There's different proposals going on right now. This whole area is still in flux, okay? But one thing that's not in question, all the money must be out of the inherited IRA within 10 years. And we don't care what tax bracket you're in. We don't know what the tax rates are going to be in 10 years, but you must take all this money out within 10 years after the second death. So what is a qualified asset? Qualified plans. These are traditional IRAs, 401ks, certain types of annuities, bonds, pensions. These are called income in respect to a decedent. In other words, these particular assets are not long-term capital gain. They're not short-term capital gains. These are ordinary incomes, commissions, payroll, that type of thing. So this character of an income in respect of a decedent on this money is still an income event to the kids. It does not get a step up in basis. So this is something that we're really having to struggle with because so many people in the country today are loading up their IRAs and 401ks, which creates the largest tax event your estate and your heirs will probably ever experience. So we call this term income in respect of the decedent. Personally, I think the IRS should have called it income in disrespect to the decedent because there is nothing respectful about the tax bill your kids are going to get. So here's the deal. It's a double tax trap. It's a double tax trap. And if you've been successful and you're subject to estate taxes, it's even worse. So what happens is when we have a large estate tax credit like we do today, it's $12,060,000 per person. Most of America is not going to be subject to estate taxes if they die this year. And as long as the code doesn't change between now and the end of 2025, that $12 million in change lifetime unified credit is very, very generous to where the bulk of our assets will transfer zero tax to our kids, except for our IRAs and 401ks. This is where we're having some planning issues in respect to Code Section 691C and 2053. Not that I'm trying to turn you docs into tax professionals or anything like that. I just want you to be aware that your tax professionals are struggling with a lack of guidance and clarity that we have from Congress and the IRS in respect to these things. So what can we do? We want to focus on those types of things. So this 691C currently is still law, which we like and can use. And I'm going to show you an example of how we hope we can capture this benefit for our kids. Now, all of you probably hear Congress is playing with the death tax, the estate tax rules. You know, last year we saw a proposal where it was going to change the lifetime unified credit from nearly $12 million per person down to $3.5 million per person. There was two other proposals floating in Congress last year, moving it down to $1 million. So the estate tax or death tax, whatever you like calling this thing, that threshold that puts you into that tax bracket is clearly a hot topic for everybody to be looking at. Without question, I don't see how we're not going to change this estate tax down to a lower number. Regardless of what that number is, I want to simplify your understanding. If your estate is subject to estate taxes, column on the left, that means your children, if they take all the money at once on $1 million IRA, they're only going to have to pay about 40% in federal tax. Now, there might be some state tax they might have to pay on this thing too. If you die subject to estate taxes, the middle column and the column to the right. The middle column is a friendly column. We still have an estate tax exposure of 40%. Your IRA is a part of your includable estate. What that means is that when we die, the IRS needs to know what is your estate: cash, stocks, bonds, Lexus, cars, couches, clothes, your stuff, which includes insurance sometimes, IRAs, 401ks all the time. So what is your taxable estate when you pass away? So Code Section 691C creates a deduction that our kids can use to make it in the middle column to where the total estate tax and income tax is roughly 60 to 62%. Without 691C as a deduction, or if your children, if their CPA does not know that they could claim a 691C deduction when you pass away, if your children's CPA does not know that they can claim a 691C deduction because mom and dad had a taxable estate with an IRA or 401k, your children will accidentally pay about 80% federal tax on this thing. So this is kind of a hot topic if you've been successful. For people who have not been successful, you don't need to worry about this because you're not going to have a taxable estate. You're going to die relatively poor or broke. Most of the people on this phone call, that's not going to be an option. For us, we need to be thinking about, okay, if I'm going to be successful, if I'm going to accumulate wealth, how should I own this wealth and how should I transfer it to my heirs? Okay, so I want to focus on that one. One of the questions I want you to write down is that if you have a revocable living trust and if you have an IRA or a 401k or other type of qualified plan, you need to ask your attorney, does your revocable living trust have an IRD conduit provision? Does your trust have a provision for your IRA or 401k to flow through it? And I'm going to connect these things together in just a minute. The next issue that I see repeatedly, IRA 401k forms are blank. IRA 401k forms go to the wrong people. They go to ex-spouses. It's amazing how many times we set up an IRA, we move from this custodian to another custodian, the forms don't get filled out. It is absolutely horrendous. You have to keep an eye on these IRA beneficiary forms. I beg of you, at least every year, pull up that form and see what you have filed with the custodian. Most of us will have our IRA 401k set up so that when we die, it rolls over to the spouse. No tax consequences under current law. Spouse then enjoys that IRA 401k. Then the spouse dies. It then goes to the children. And at that point, it becomes an inherited qualified asset. Will estate taxes eat up your IRA? Yeah. Now, right now, like I said earlier, most of us are not worried about this issue because the lifetime unified credit per person is just over $12 million. So we don't have to worry about this. But if that number comes down to a low number, many of us will have to worry about estate taxes and income taxes eating up our IRAs when it goes to our children. And as I mentioned earlier, overwhelmingly, kids do not leave the IRAs and 401ks alone. They yank that money out. It is spent and taxed. So to put things in perspective, as a nation, what we typically see happen, people set up their IRA, they load it up to the max, they get a good financial advisor, they grow the money well, and when they get to that RMD age, currently 72, but about to change again, 90% of the people who make it to age 90 will still have 90% of their IRA intact if all they do is take out the RMD each year. Remember that fraction, like right now at 72 is a little over 3.6% that you shall take from your IRA for the RMD. So if all you take out is just the RMDs, there's a great chance your IRA will still represent a huge portion of your estate that needs to be considered for overall estate wealth transfer. So at death, what do we know? The kids, they're not going to leave the money under management. Many people, unfortunately, think that qualified plans get a step up in basis like your house, real estate, stocks, mutual funds, etc. A lot of people think that ERISA inherited plans are qualified by state law. So let me clarify that real quick. A lot of people falsely believe that when kids inherit an IRA or 401k, it has the same degree of asset protection afforded under state law or ERISA. It does not. In fact, the court now considers inherited qualified plans, specifically traditional IRAs, as untaxed property settlements. I'm going to go into what that means. This all changed in 2014, and everybody's like, what? Now I'm going to start putting pieces together here so that we can go, okay, that's the situation. Here's where we're at. There's a lot of gray in current law. And I'm going to show you one of the tools that is extremely powerful to play this game better than the IRS and Congress. So when we look at the nation from a charitable receptivity point of view, 20% of us are just, we love giving to charity and we don't care what the tax deductions are, we're going to bless charity. 60% of the nation is definitely open to giving to charity. In fact, we typically find while we're breathing, we give to 5 or more charities per year, about 70% of the nation. And we still have some part of the nation that has no charitable receptivity at all. In fact, they could care less if mom is in line at the soup kitchen. So let's talk about qualified charitable distribution. This is one of the most powerful tools we have at our fingertips once you become age 70.5 and you have these IRAs. The rule is this simple. If I'm 71 years old and I'm going to give $1,000 to charity, okay? If I've done nothing else as far as claiming more deductions, expenses, in other words, I'm just going to be a standard filer, chances are that $1,000 is not going to be a charitable income tax deduction, because on Schedule A, which is where we claim all those extra deductions, if it's less than my standard deduction, being married or single, as you can see on the columns down here at the bottom, if my Schedule A number is less than these numbers, that $1,000 I gave to charity technically did not get me a single penny of charitable income tax deductions. In fact, we find that most of the nation gives to charitable causes. They get no charitable income tax deduction because their giving is less than their standard deduction. And this standard deduction is the highest we have seen in almost 5 decades of tax law. Here's a better way to bless charities if you're not going to itemize, in other words, have a bigger deduction. If you're 70.5 or older, and you've made that decision at age 71 to give $1,000 to your church, hospital, university, whatever, more than likely it is tax smarter for you to give money from your IRA that will go direct to the charity that you want to bless, because at this point you're not creating an income tax event for yourself. The charity's getting gifts from your IRA that has probably money in it that has never been taxed. Charity still got the $1,000. There is a cap on this of $100,000 per donor per year. But the point is, this is probably the most tax smart way for donors over 70.5 to bless charitable organizations, specifically if they don't itemize. And I can even argue that even if you do itemize, this is probably a smarter way to go, which is to use the QCD, the Qualified Charitable Distribution Rule, to bless a charitable organization with monies directly distributed from your IRA to the charity. It is a powerful tool. Not everybody knows about it. It's been law for many, many years. And this is a great discussion for you to have with your CPA, your tax attorney, your financial planner, your tax preparer, etc. There is a way to give and be tax smarter about it. Tax mistakes upon death. To make this simple, everything on the left-hand side of the screen under current law gets a step up in basis and transfers zero tax to your heirs, as long as you're not subject to estate taxes. Your IRAs and 401ks, whether you're subject to estate taxes or not, is always income tax to the kids and potentially subject to estate taxes. So I want to give you a case study, and this is out of chapter 17 in my book, and I get more calls to talk about this than anything in my book. But here's Tim and Susan Miller. The names have been changed to protect their identity, but it's an actual case study. Their goals is to transfer wealth to their heirs, free from tax, free from lawsuits, and free from creditors. Okay, I think most of the country has these same goals. They have 4 children, and Tim died in 2017. Susan's before us asking for help in respect to updating the estate plan and addressing the issues of the estate. 4 kids, a house worth $400,000, cash and stock worth $400,000, and Tim's rollover IRA to her, $800,000. Many of you are looking at this going, wow, we thought that Ed was going to be talking about high-end tax issues. Yes, here we go. This is a high-end tax issue. But many of you are going, the down payment on my house was $400,000. I mean, so this is a very modest estate. And using this modest estate, I'm going to show you why this works for even larger estates. Now, the good news is she already had a will and a trust in place. All the investment assets were titled to the revocable trust properly. Remember, IRAs and 401ks are not titled to the trust. They're owned by individuals. The house is titled to the trust. The IRA beneficiary forms were completed properly. And Susan and Tim's estate plan basically said that when Tim and Susan are gone, everything is distributed equally outright to their 4 children. This is the most common framework of an estate plan in the nation. Here are the 4 kids. Mike is a successful doctor, $25 million net worth, in a good marriage. Chances are the last thing Mike needs is more inheritance to have a bigger estate that's going to be taxed. Mary, well, she's not in the greatest marriage in the world. In fact, at Tim's funeral, her husband was heard making the comment, I can't wait for mom to kick the bucket so we can get a new boat and a new truck. Yeah. Ed's in a rocky 3rd marriage, but good with money. And then, of course, we got brother Dan. Now, granted, probably none of you on this phone call have a brother Dan, but Dan can't manage money, currently divorced and looking for work. What do you think the chances are that Dan's going to miraculously change his behaviors and be better after mom is gone? So giving Dan a pile of money, I don't know if this is a good thing either. Well, let's first look at this thing from a tax issue when mom passes away. As you've learned, the house and other assets step up in basis, but the IRA 401k is always ordinary income to the kids. So since it's an equal distribution of $1.6 million to the family, each person gets $200,000 cash, no tax. Each person gets a 1/4 share of the IRA. So basically, each party gets $400,000. Half of it's tax-free, half of it exposed to tax. Now, if Mike takes out the entire $200,000 on day one, he's going to lose, what, nearly $100,000 here in the great state of California because he's already in the max federal and state tax brackets. So this is why this thing has to be given some thought to. And if we give brother Dan $200,000 cash outright and a $200,000 IRA that he can liquidate this year, will Dan be smart enough to remember that he needs to hold back some money on that IRA to pay his tax bill next year? No, Dan's not going to remember that. Dan's going to spend the money. And then when Dan gets a big tax bill, he's going to go to Mike, Mary, and Ed and say, hey, I need money. We need to put some handcuffs on some of these kids and to help these kids. Here's the thing we need to be focusing on. We're not talking the IRA transfer process through with our advisors properly. We're not asking these questions. So this is what we need to be doing. First, let's understand Clark v. Ramaker. This was a game changer. Mrs. Heffron died in 2001. She had a house, she had an IRA, and some cash. The daughter elected, under the old rules, stretch option, which was a smart play for her. Her and her husband were computer programmers making good money. The last thing she needed was to take that $450,000 IRA outright and pay a big tax bill. Well, they inherited this money. They were doing well. Next thing you know, they got in debt. They had some problems in 2007. And then as things progressed from 7, 8, and 9, their CPA recommended that they file Chapter 7. It was a bad scenario. So they filed and they got approved initially, but the creditor said, not so fast. She's got a $450,000 inherited IRA out there. Why can't she use some of that money to get this $300,000 debt paid up? He wins at the appeals court and they go to the Supreme Court. And at the Supreme Court, the creditor wins again with a unanimous 9-0 ruling. Do you know how often we see a 9-0 ruling out of the Supremes? So here we are with a 9-0 ruling in 2014 that basically said, we agree that she has a $450,000 IRA, which she did not create, which she did not contribute to. Therefore, it does not have any degree of bankruptcy creditor protection. And for the first time, we finally have an answer in respect to the law. Are inherited IRAs safe from bankruptcy judgments? And that answer is no. And so the creditor wins. He gets to have a judgment of $300,000. And so the IRA custodian does his job, and he distributes the $300,000 to Heidi to pay the judgment. And then on January 1st of the following year, the IRA custodian also issues to Heidi a 1099-R for the distributions for Heidi to pay the taxes on a $300,000 distribution. If you think about this, this nightmare began nearly 7 years earlier because Heidi ran out of money. And now she just lost $300,000 and change of the IRA, and she's got to pay the taxes on it. Where's Heidi going to get the money to pay the taxes on this IRA distribution? So unless your kids are somehow never, ever, under any circumstances, ever find themselves at the courthouse with a judgment, we need to put some wheels around this thing so that we can protect this from happening. So there's some planning opportunities that we need to be thinking about and talking about that hopefully after this session, you're going to say, hey, we need to start looking at this IRA with the same amount of importance as we look at our overall estate plan. So with Clark v. Ramaker on the books from 2014, and there have been several subsequent decisions in several courts from 2015 and 2018 and even recently that have indicated that these assets are in play for bankruptcy judgments and even some other issues, we have to think about what to do. So to put this in simplistic terms, while mom and dad are alive, if you have an IRA or 401k, you have a degree of asset protection on those assets. When mom and dad are gone, there is no asset protection on those assets. So we have a period of 10 years if the money stays in the inherited format. And then at the end of the 10 years, we have the IRA distribution. But the red period, if there's anything that causes that IRA to make a distribution because the kids want it or because it's to satisfy a bankruptcy judgment, there is a 1099-R going to be distributed. So Susan wants something better. She's not crazy about this new 10-year rule. She doesn't like the fact that the IRAs could be hit by their children's creditors for whatever reason. She wants to transfer the IRA with the least amount of tax to the kids. I mean, look at the son, Mike. He's in the max tax bracket. Susan would like to give her kids an income stream from the grave. Boy, this is huge for actually 3 of the kids. And Susan, if there's any way possible, she would like to leave a little bit of money to her church. So how would you feel about your IRA if you could give your kids a check from the grave 20 years after you're gone? To make that check where there's less tax on that IRA asset as it transfers to the kids over 20 years. And if there's a way to give the IRA value away twice, once to the kids as an income stream, and then once to the favorite charities instead of the IRS charity. Okay, none of us are crazy about giving to the IRS charity. So here's one concept that I really love. There's the estate of 1.6 million, the non-taxable part, which is the house, cash, stocks, step up in basis, is transferred to the kids, no tax issues whatsoever. We're going to have the IRA go to a testamentary charitable remainder unit trust. Charitable remainder unit trust is testamentary, meaning here's the testamentary trust. It's sitting here unfunded until we're dead. And of course, testamentary meaning you're dead. So after our death, money goes from the IRA accounts to the charitable remainder trust. The 4 children are the income beneficiaries. It gets a payout of $42,000 divided by the 4 kids. So we're looking at about $10,000 and change per child. So if we give $10,000 to each child over the next 20 years, we have a degree of income tax efficiency for the kids. We actually are going to save some money for the kids. And so we distribute the $42,000 every year over the next 20 years to the kids. Now the trust has run its course for 20 years. It was a term certain 20-year trust. Mom and dad died. The IRA went to the trust. The charitable trust did its job for 20 years. At the end of 20 years, whatever's left in that IRA, that charitable trust now, goes to her church. When Susan saw this, she literally had tears rolling down her cheek. She couldn't believe the one thing that she was worried about the most the one asset that will be taxed the greatest of anything that she owns, the one thing that would impact 3, if not 4 of her children in a negative way, she was able to give it to the kids with greater tax efficiency, a degree of asset protection from the charitable trust. And then when the trust is done, her church gets a $898,000 charitable gift. You know, folks, we were all sitting there with tears rolling down our cheeks. And she was like, I can't believe this is true. If only Tim is here to see this, it would be just wonderful. We don't have to die or have one of our spouses die before we get this kind of clarity. This is just really good planning that anyone with an IRA or a 401k north of $500,000 or $600,000 should strongly consider using as part of their overall death plan. So I call this the Give It Away Twice plan, chapter 17 of my book. You do need to have a real attorney that will help you with the design of the charitable trust, because remember, we're not funding it, we're just designing it, getting it ready. We need to identify the beneficiaries and the charities. Okay, do we need to have all 4 kids on there? I don't know. I mean, Mike, the doctor, I get it. We love all the children equally, so they're going to all get something, even though it may be tax improper. But we want to reserve the power to change the charitable remainder, man. In other words, we name the charities today. What if we don't like one of the charities in 5 or 10 years? We need the power to change that. Typically use a conservative 5 to 6% payout rate. Susan can choose to have the checks go to the kids monthly, quarterly, semi-annually, or annually. Quarterly is typically the most common distribution scheme that I see, but for the son, Dan, he might need monthly because he's just not good with money. And we're going to change the IRA designated beneficiary form to be the trustee of the charitable trust for the Miller Charitable Trust. Now, here's the deal. While Susan is alive, nothing changes with her IRA. She still takes RMDs. She can still take all the money she wants. She can change the beneficiary form whenever she wants to. But when Susan dies, whatever is on that designated beneficiary form is the law of the land for her that day. The trust remains unfunded until Susan's death. So she stays in control. She does not lose any control while she's alive. So the IRA to the correct beneficiaries. It's an irrevocable type trust, so it does give us a degree of creditor protection for the kids. Mike being a doctor, yeah. What about Susan? You know, her children there with Mary, possible divorce for her. Yeah, so there is a degree of asset protection here. The crut's outside of everyone's taxable estate. That's good news for Mike because he's already subject to estate taxes. CRUT will give 20 years of income with less tax exposure to the kids. Charity gets a big fat gift. And winner chicken dinner, the IRS gets less. Easily, we're going to save about 30% of the tax bill that the kids would have had to pay had they taken the money outright or over a 10-year period of time. Susan loves the fact that her children will get a direct deposit in their bank accounts to remember her and Tim for the next 20 years after she's gone. And Susan is very pleased that the IRA will not be subject to the kids' creditors, because once Susan became informed about this IRA asset needing some help, she was more than happy to be able to identify that, yes, every single one of her children do have some form of degree of asset protection needs after Susan dies. Mike's obvious. Mary, what if she ends up with a divorce from her husband? Ed, well, his wife's filing for divorce today. And Dan, truly, there's more planning that I think needs to be done for Dan, because Dan needs to have an income stream, not an outright inheritance, but that's a seminar for another day. For the rest of Susan's life, she maintains full control of her IRA 401k. I need to drive that home. All of this planning has to do with once she dies. Between now and then, she's in control. She can change the beneficiary forms. She can sleep comfortably every night knowing that the kids have a safety net. The kids get a big fat gift, and Tim would be very proud of her. So I want to compare the rules that we have to start dealing with. The kids can just take on $1 million IRA. Let's say that you have one child, second death, and we have the IRA going to the one child. Here in California, where we love taxes, $1 million outright distribution, easily $450,000 tax bill if we're lucky, $550,000 net of tax money in your pocket. If we have the son elect the 10-year rule, we have $1 million. He better stay out of the courthouse for the next 10 years. If he doesn't, he could end up with a judgment. Technical loss here is the actual inheritance plus the tax bill. By the way, where does that $450,000 tax bill come from if we're trying to satisfy a $1 million judgment? The IRA to the CRUT, $1 million. We have 1.1 being paid out. We have a $250,000 tax bill. The wealth gain and the net to charity in that scenario is significant. Without question, when you start comparing risk and reward, it becomes, why am I not already putting a plan like this in place for my IRA and 401k? I call this the bookend. This is the Hail Mary. This is the strategy that if something bad happens, you're gone, and we have these large IRAs, which one of these 3 distribution rules is going to work best for your family? If anyone can come up with anything better, I'm all ears. But now that these inherited IRAs are subject to judgments and that type of thing, we have to be careful. So we got to be planning for this stuff. Issues for the charitable trust is an oversight, just so you kind of know how important these things are. It's not like these charitable trusts are out here running around willy-nilly doing whatever they want to do. There's a formality to this. There are a lot of rules, state authorities, tax returns, administration and reporting, rules on how the money can be invested, rules against self-dealing, how we terminate a charitable trust if it's necessary. And then there's still always IRS unclear guidance. You would think with 80,000 pages of federal tax code, there would be nothing unclear. Guys and gals, I'm telling you, there is still a lot of gray area when it comes to what do we do with these IRAs and 401ks while we're breathing, even more so once we're gone. So we've kind of covered a lot of material over the last 30, 35 minutes or so, bringing you to this point of, wow, where am I at? I didn't understand all this stuff was going on. I didn't think these IRAs and 401ks were so complicated. I thought all I needed to do was put as much money as I can, find an investment advisor, manage the money, grow it, and then take it out only when I have to. I would say that probably the greatest misunderstanding that I see with families is they have this presumed level of training that, okay, we only take out the RMD. I would argue that when you become of RMD age, currently 72, the right question to ask is, what should I be taking out of my IRA to capitalize on how efficient the tax code treats all my sources of income? So for example, if you go into a retirement age, one of the things that I love to see people do, if they're in the 16% effective tax rate, the best tax rate to be in is the 24% tax rate or less. So if you've got that window there of between 16% and 24% of money that you could be taking from your IRA with a less tax exposure because you're below 24% effective tax rate, which is the sweet spot, why don't you take out more from your IRA? Yeah, you're going to pay a little bit of tax on that money, but now you've got more money that you can deploy in other ways that can grow and also transfer more tax efficiently to your heirs when you pass away. For some reason, we as a nation go, let's don't touch that IRA money, that 401k, until we have to. And when we have to, let's only take out what we must. In fact, I'll go one step further. Once you turn age 59 and a half, the question needs to be, should I start taking money out of my IRA now? We don't want to miss planning opportunities where you can take a hot taxable asset. Remember, that IRA 401k is going to always be subject to an unknown future tax rate. And if I know what my tax rate is today, and if I know where the sweet spot is in the federal tax code, why am I not using that opportunity at age 59 and a half to liberate this hot asset from an unknown future tax rate and put that money into something that is known, that we can control the tax rates? That's the thing that overwhelmingly the nation goes, oh, just put money in wait till you get to be the right age, take out only what you have to. That is absolutely the wrong way to be looking at these IRAs and 401ks. Now, let me preface that with, when I'm younger than 59 and a half, load these puppies up. Load them up. But load them up with the concept of, I'm doing this now to grow wealth tax efficiently so that I can liberate this money to work for my greater benefit once it's the right time, which is 59 and a half. All right, so let's get to the end of our presentation here.
Actually, if we can go back, Ed, we do have some questions, and Mark, I'll let you handle those.
Yeah, so we had one that came up about the 691C. Someone was asking, is there any way to file that so you don't have to rely on your kids knowing to file that ahead, after you're gone?
Unfortunately, you're not going to be happy with this answer. So I did a survey last year with about 100 CPAs, and I asked them, now granted, the last 2 years for CPAs have been a nightmare. I mean, it has been crazy. But I asked them, where do you file that? Where does that go on the kids' forms? There isn't a place on the forms. Most CPAs don't even do estate taxes. They're like, my practice does not do 706 tax returns. We're not worried about learning any of this stuff. If somebody dies and the child is my client, but mom and dad are not my client, unless somebody tells me where to claim it, what to do, we don't know what to do. So here's the advice you can go ahead and write down in your notes so that you can give this information to your kids' CPAs. It goes on Schedule A under Other. That is where you claim what we call the DRD deduction. Remember, IRD means it's subject to income taxes. We're trying to argue that it's a deduction for the kids to claim on their 1040 Schedule A under Other. It will blow your mind as to how many tax attorneys and CPAs do not know where to claim 691C. Good question.
And then another good question that is a topic I'm a fan of, which is, what about Roth conversions filling up to that 24% tax bracket?
This isn't one of those technical questions where you always want to be looking at everything and what your age is and what your goals are. Currently, Roths are beautiful things because you put after-tax money in and they grow tax-free. Now, there's a few rules on 5-year rules, stuff like that. What the biggest mistake that I see people do is they do only one level of retirement planning. They only put money in an IRA or 401k thinking that is the only way that they're going to retire in style. I'm going to have to respectfully say that is too narrow of a thinking process. You need to be doing comprehensive retirement planning where you're looking at the Roth and even life insurance as a retirement structure. I mean, people go, what? Life insurance is a structure? Well, yeah, there's a way to use life insurance as a retirement income structure that's a zero tax income event because it's not an investment, it's not an income, it's a loan. People, they don't look at how to fill up all the buckets. They just, well, my CPA said I can put money in an IRA and a 401k, and I heard it on TV and I saw it in the newspaper. So clearly that's the only thing we can do. I would say most people do not do comprehensive retirement planning well. They truly don't. But Roths, I love Roths. You know, the current law, we have no tax issues in respect to the Roth, but I do believe that we will start seeing the Roths get looked at a little bit harder when you start thinking 10 years down the road. You start thinking how Medicare and Social Security are going to be really stressed at those points. How do we balance some of the cash flow issues for the National Treasury? So right now, load up those Roths. I love those things.
Yeah, perfect. And we do have someone with their hand up. If you do want to put your question in the chat box, we will get to that in the lineup here. We also had, for the charitable planning, does it have to be a 20-year period, or can it be set at a different length of time?
It can be 20 or less. 20 or less is a testamentary federal rule that basically makes it so that if I want to do an 8-year, 12-year, or 20-year term trust, but I will tell you from an efficiency perspective, as far as the greatest tax benefit to the kids is to give the kids more money at a smaller amount over a longer period of time. That gets to tax efficiency. I do want to go back to the 24% question real quick. the sweet spot in the federal tax code from 0 to 24%. Can I do the stop share so we can go to a big screen on this, Marche?
Yeah, you can go ahead and do that
I
yourself.
kind of need to use the hand
There
gesture.
we go.
Right. So in the lower tax brackets with my hand right here, we have kind of this little gentle curve that goes up to 24%. But once we get to 24%, we start getting that hockey stick where the tax rate, the amount of tax money that they take from us really starts to curve up after 24%. So the reason I like 24% under the federal code, and getting back to that brilliant question about why is 24% the sweet spot? If I have an IRA and I'm over 59 and a half, and you've got all these weird complex rules about working, funding, et cetera, but let's just pretend we retired at age 60, and we're trying to decide what do we do with this $1 million, $2 million, $500,000 IRA. If my income is 16%, and if I can take 8% money out of my IRA today, to get me up to the 24% mark here, okay? I take that money out, I pay less tax on it. Can I fund a Roth? Some technical rules here about can you open a Roth, fund a Roth, et cetera. Yes, because think about this. If I can take out some money to get me up to the 24%, and if I'm eligible to fund a Roth, I'd fund a Roth. If I'm not eligible to fund a Roth, I would fund anything similar to a Roth. Okay? Remember, the goal here is the best tax goal here is to use up your IRA and 401k before you die if you can stay in a lower income tax bracket for your entire life. That is the best thing to do, because if I can consume my IRA to be my primary source of retirement age, keeping me in a lower tax rate theoretically, that means the rest of my estate will transfer zero tax to my kids. Okay? All right, so we're getting kind of long in the tooth here, but we're getting to the top of the hour.
Yeah. And I did have one more question come in. Well, I had a couple questions, but I think we have time for one more, which was where someone was asking, where can they go to read a little bit more about the charitable strategies with the IRAs and 401ks?
Great question. Of course, my book, Chapter 17, reach out to Mark. He'll get you a copy of it type thing. A lot of the major charities now have caught on to this. Wow, this is pretty brilliant. So some of the major charities, hospitals, universities, you can approach their planned giving department and ask them for materials on it. There's tons of this stuff on the internet now available to this. It is one of those things, though, where we have a learning curve for all of the advisors, the attorney, the CPA, the financial planner, the banker, whoever you rely upon. They'll hear this term, there's this charitable trust. Well, right there, people go, I don't really know that much about it. And then we go, there's this testamentary charitable trust to receive IRAs. Not a lot on that one either. Probably one of the nation's foremost authorities on this is a lady by the name of Natalie Choate. She's got this beautiful orange book on tax. It's like $100-something for that thing. Really, really technical. But most major charities, if you say, hey, I've got an IRA, I'd like to talk about leaving the IRA in a charitable trust, most of the major charities will have a relationship with an attorney that can even help you get the testamentary charitable trust prepared and walk you through the processes. But don't rush it. Take your time, do your homework, ask lots of questions, read Chapter 17 in my book. There's tons of information out there about it, but you have to go find it, unfortunately.
Well, I think that's about all the time we have for questions. I do want to tell our attendees that if you have a question we haven't been able to answer, go ahead and leave your contact information in the chat. We're happy to reach out to you after today's event to make sure that gets addressed. And even if you think of a question while I'm closing things out, I'll go ahead and save the chat so that we can get that taken care of for you. Well, I want to thank both Ed and Mark for being here. What a very informative webinar, and we really appreciate that. We want to thank our attendees for being here. Like Ed said, look for a replay soon for so that you can watch this over again. You're welcome to share it with friends and family, and we will also be putting this on our website as well. Here at Advice Chaser, we're all about helping people find a financial advisor who's great fit for their life and their financial questions. Our matching service is free, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Bye, everyone.